Welcome to Getting Retirement Right, where we strive to simplify your financial life and provide you freedom from taxes, risk, stress, and poor advice. And now, here are your hosts, Darrin McComas and Shon Peel.
All right, let's get started. Talking to Shon Peel.
And I'm Darrin McComas.
And this is Getting Retirement Right.
Hey, we got a great show planned for today. Really, today's theme is about minimizing taxes in retirement. I think everyone is worried about taxes, and rightfully so.
Well, they're literally right around the corner. And I don't know about you guys, but I love to ask this question, right? Who feels like you don't pay enough in taxes? And everybody always laughs, right? We're in a live room. It's a podcast, so it's a little quiet right now. So it's just you.
I'll
so
laugh.
I appreciate the laugh. Yeah, that's good. But taxes are something you have to plan for. I mean, they're not going away. And here's what's interesting. You go back to a long time ago, they started with taxes. Right? They didn't come in with force. It's like the water was slowly getting warmer, and the way they started reform was with taxes. So we need to pay attention because I think we're at all-time lows, and they're going to go higher.
Absolutely right. And no one wants to pay the IRS one more penny than you absolutely have to, right? And, I always say, don't leave the IRS a tip, but unfortunately, a lot of retirees do just that. And being as tax efficient in retirement, it can make a huge difference between really having a successful retirement or a very stressful one.
Well, it's interesting that people are worried about inflation, they're worried about market volatility, but yet we talk about being proactive. And proactive is getting out ahead of things before they're going to happen. And when you look at the Trump tax code, just for instance, it's going to expire at the end of 2025. And if nothing gets changed, there's an increase coming January 1, 2026, because you're going back to the Obama tax laws.
And let's face it, Washington, D.C. is a mess.
It is.
You got a divided everything in that city, and the odds of any major tax legislation getting passed is slim to none. So, we always deal with what we know. We know the current tax codes. We go back to the Obama era tax codes in 2026, which is a significant increase in most of those brackets. So,
well, let's just give an example, right? You take the median $78,000 husband, wife, they're right around 12% for a tax bracket. January 1, 2026, it jumps to 25%.
Yeah, on that marginal end. So more than doubles, and that's a scary number, and it can have a big impact on, obviously your budget and how much money you got to pull out of those tax-deferred accounts.
Well, a couple of weeks ago, we were talking about having a plan, right? We were talking about addressing all the issues that go into a plan. And for us, we just don't see the value in putting together a plan without addressing taxation. It's kind of an invisible, kind of moving target, whatever you want to call it. But for most of our clients, especially high net worth clients, tax planning, we believe your plan should start with taxes.
Absolutely. And it comes down to this. You worked most of your life, right? You got to contribute to that work-based 401k or IRA, and you were allowed to write off those contributions each year, right? Save you a little bit in taxes along the way. Sounds like a great deal, right?
Sounds wonderful.
But now you're in retirement. No more, you're not contributing anymore. And the IRS comes knocking at your door saying, guess what? We want our taxes.
Well, here you can do some research on this, but someone works for 20 or 30 years, and every penny you put in, every penny a match, and every penny of growth is going to be taxable. But you only deferred out about $75,000 in taxes of savings, so to speak. But yet you have a $400,000 to $500,000 tax burden, and it's not hard to figure out why corporations went to the 401k strategy, right? It was definitely better for them and better for the government long term because they're going to tax a huge nest egg at the end of it.
You've been contributing, you got that company match, but here's some interesting statistics I just pulled. Over the last 10 years, the S&P 500 is up over 150%. The NASDAQ, which everyone loves those tech stocks, is up over 250% in the last 10 years. So
good to get the growth.
Good growth, right? Makes a lot of sense. The 401k, the IRA has really grown over the last decade, but all that growth really comes with a price, and that's increased taxation in retirement for most people.
Well, and it's, I'm not that worried about those accounts. We're not going to really spend them. We'll pass them on to the kids. But wait a minute, they're going to get taxed at some point. And the government says, well, now at age 73, thanks to the Secure Act 2.0, you're going to have to start pulling out RMDs, required minimum distributions. Why don't you just kind of walk us through why that's important and what that even stands for?
Yeah, that's really at the epicenter of this tax issue is those RMDs, required minimum distributions. And the first word, required, it's something that you're going to have to do for those tax deferred accounts. And it starts at age 73. A few years ago, it was 70 and a half. Then it moved to 72. And now with the newest legislation, they bumped it to 73. It does count as ordinary income. So I think the number is around 4% that first year, roughly, of all the tax deferred accounts that you have, add them all up. And it's close to 4% is what you're going to have to pull out that first year. And that all counts as ordinary income and is subject to state and federal and even local income taxes.
Well, and here's the thing, right? You grow up your whole life, we're educated to the fact that once we're retired, taxes are going to drop. But that's actually not true. It's because when you start thinking of required minimum distributions, the taxes you pay on that, you have some pensions. Oh man, that's going to affect Social Security. We start to see a trickle-down effect that's like, wait a minute, we need to plan for this.
Yeah, and here's the key thing. Those RMDs, that RMD schedule isn't static. It goes up each year. So while it starts at around 4%, pretty soon, after a few years, it goes to 5, and then you're at 6, and it just accelerates, and it can cause a significant bump in your ordinary income. And therefore, you find yourself start to jump tax brackets. And I think a lot of Americans had that faulty assumption, I'm no longer working, I don't have that paycheck coming in, don't have that income, my taxes are going to be lower, I'm not really going to have to worry about it in retirement. And that may be true. Your first few years out in retirement, maybe you're have some savings you're living off of and Social Security kicks in and you're fine. But then you need more income. You need to take a trip. You start pulling money out of those IRA, 401k accounts, and it starts to add up.
Well, this is exactly why the set it, forget it strategy doesn't work. Whether you need it or not really is besides the point. That money at some point is going to play a role within your plan, and it's how do you get the most tax efficient use of that money possible. So maybe you're not going to touch it. You're 65, you're fully retired, you have a good amount of income. But if we know taxes are going up in the next 3 or 4 years, why wouldn't we put some strategies in place to lower that tax burden going forward? What's maybe one of the strategies that the team uses to help people lower their tax burden?
So, right at the number one strategy we use is called a Roth conversion, where you're taking traditional IRA money or 401k, 403b, any tax deferred money, and you can systematically convert that into a Roth IRA. Now, you can do it all at once. There is no limit on how much you can convert. The IRS, hey, if you want to convert your whole IRA, which we don't suggest, in one particular year, you can do that. It's just going to get all taxed.
Let's pause there for a second. So this is a big misnomer in our industry. It's very confusing.
Absolutely.
We are talking about there being no limit on conversions. There are limits on contributions because if it's too good to be true, they're going to limit the amount of money you can put in there. So when you can put in or contribute, say $7,000 a year to your IRA, that's the limit. When you want to convert from your IRA to the Roth, there's no limit. That government wants their tax money. It's just going to probably jump you up in a few tax brackets if you do a lot at once.
Yep. So the minimum age is 59 and a half when you want to start looking at doing some conversions. And,
and hopefully you're not working anymore.
Right.
That's the other piece.
You got to look at your earned income and where you're at. And so there's a lot of pieces that go into making the decision, do we do a Roth conversion or should we hold off? And I'll just say this, Roth conversions aren't for everyone, but if you have a significant amount in tax deferred money, I use just a good round number, around 500,000 sitting there tax deferred. It might be a good place where you want to look at Roth conversion strategy to get more tax efficient. Let's take advantage of these historically low tax codes that we're under. We still have a couple years to do this. What money can we move now at on sale, really, when taxes are on sale, get it over into the Roth? Yes, we have to pay those taxes now. But again, if it puts us in a better place down the road, it's probably in your best interest to look at that Roth conversion strategy.
Most definitely, too. And you look at long-term care, for instance, you get a lot of people that are like, okay, I'm not going to purchase long-term care. That's too much money. I will use this other money down the road. What a great bucket to pull from is a non-taxable bucket. That Roth, once you've paid taxes on it, Every penny of growth is now non-taxable. So if you and your wife need 15, 20, 30, 40, $50,000 when you're 85 to some in-home nursing, some sort of care, that money's tax-free. Now, here's the other issue. If you are 85 and all that money's still sitting in the IRA, you're talking about major implications to the rest of your retirement plan.
Absolutely. And we're huge proponents of the Roth. I think it's the greatest weapon today's retirees have is having a Roth IRA. Like you said, all that growth is tax-free forever. And including one day, if you pass that Roth IRA onto your beneficiaries, it's also tax-free to them in most cases. And it's such a powerful tool. And why not take advantage of looking at, and it takes a lot of planning. There's a lot of decisions that go into, is it right or should you not do it? So I don't want anyone out there just to wing it and throw out a round number. Hey, I'm going to do 100,000 this year. I just talked to a lady yesterday out of the San Francisco area, and she just did a round number. She didn't know what to do. So 100,000 sounded like a good number. I don't know. It probably put her way too high in the tax bracket. She's filing single. There's probably a better way to do that. So when we do a Roth conversion strategy, we're looking at spreading out the taxes over multiple years, not trying to cram them into 1 or 2 years.
Well, tax savings is great, but what is the impact to the rest of the plan? Because if you make too much money, and since this is taxed as ordinary income, guess what? You're going to affect your Social Security check. You're also going to affect that Medicare bill. So you could be paying way more taxes on a Social Security check. So just visualize this. Now you're getting less of a Social Security check, and you have a bigger Medicare premium that has to be paid every month. So again, we always say this, you don't wing it. You need a plan. It has to be a strategic way of doing these, or you're going to be in the wrong tax bracket quickly. And a few of these, you can't undo the mistake.
No, you can't undo a Roth conversion. They closed that loophole a few years ago. So this is where it pays to work with a professional. Get a fiduciary financial advisor, financial planner that has great tools at their resources where you can look at all the pros and cons and you know exactly what that tax bill is going to be. But more importantly, does it put you in a better situation going forward? And I think that's what we do with our clients every day. We spend a lot of time just talking about being tax efficient. I love Roth IRAs because we preach diversification too, not just with your investments, but also with your taxes, right? You want to have some tax deferred money. You want to have some tax free money. You want to maybe have some non-qualified money so that you're well diversified tax wise too, to minimize your income in retirement. Gives you a lot of flexibility.
I think it's really important too that there's a plan of how that money's being managed. You and the team have a very effective way because, look, that money can't be invested the same way all the other money's invested. You can't pay 20% in taxes and then lose 20% in the market. That doesn't make a lot of sense.
Yeah, you'll never make up that to justify doing the Roth conversion. And so yeah, we are very protective of our Roth IRA accounts, but we also know in order to justify them or make them pencil out, we got to get that money to grow. And that's really where you're using the market to pay back your tax bill. Plus all that growth is tax-free again. Can't say that enough.
No, I love that. So another thing we want to talk about when we're talking about taxes, and we see a lot of people run into this. We had 2 aunts widowed before the age of 60, is the widow tax trap.
That's a great point.
Because, men don't live as long as women. And the average married man is older than his spouse. So you look at a situation where the husband passes away and she has all his IRA money, and now she's forced to take out those required minimum distributions, and she's filing single. And we work with a lot of successful women, and guess what? They're taking their RMDs at the same time. And so now you have 2 extra incomes that you kind of didn't plan on. And maybe she's getting a portion of the pension. Maybe she has her own pension. And the next thing you know, up to 85% of that Social Security check is now taxed, and she's only getting one of them, by the way.
Right.
And wow, we're running into an issue.
It's a tax trap. It
is a trap.
And it is a mess. And it could have been completely avoided.
Most of the time,
Again,
yes.
Let's deal with what we know. We know males typically die a lot earlier than their spouses. So
7 to 8 years.
So being proactive, planning for that unfortunate event is important. If you really want to protect your spouse and make sure a lot of that money you left behind isn't going back to the IRS, because when you lose a tax filing status, married, filing joint, the tax brackets are much wider, right? And there's a lot of breadth in those brackets, and you can stay in the lower tax brackets. Now, one of you passes away, the RMDs don't go away, and your tax brackets basically get cut in half, and you can jump, for example, from the 12% to the 22 within 1 year, and maybe go to the 24 in a few more years. So it just eats up that IRA faster and faster.
Well, we've seen retirees talk about, their real estate taxes, right? And so all of a sudden everything's fine. You don't make enough money. We're not going to pay any real estate taxes. But then Mr. Jones passes away and you have all this other extra income. And now you're filing single. And the next thing you know, you also are paying real estate taxes every year. So there's all these little bits and pieces to your puzzle, which you're going to hear us talk about it all the time. Your puzzle is completely different than the couple down the street. But there are all of these issues that taxes deal with head on. And it's like, man, it's one little domino falls and it affects everything else.
Absolutely. And, we talked about RMDs. We've talked about Roth conversions. Another strategy that we're starting to use a lot with some of our clients are QCDs, qualified charitable distributions. So when you hit 70 and a half, the IRS allows you to take a portion, all right, out of your IRA, and you can donate it to a charitable organization as long as they're a nonprofit and have all that paperwork and are legitimate. You can donate some of that to them, so you get to donate, and you also lowers your taxes at the same time. It's a wonderful tool. They left that age of 70 and a half from the old legislation.
I love that.
So if you're getting close to that, and you already tithe to the church, or you already give to a nonprofit organization out of your checking account, talk with the professional about what's the correct way to do a QCD, and you can kill two birds with one stone. You get to give, and you also get to lower your taxes.
It's also like the gifting opportunities, right? I mean, the more you read about the impact of money to younger generations and being able to watch it and appreciate it and see kids enjoy it, why not? And there are a lot of ways that you can pass on that wealth and get the tax break by taking advantage of that. So you can see that we probably could talk a lot longer when it comes to taxes. And you're going to continue to hear us talk during our live community, which is going to start here in a couple of weeks, and on our further podcasts, that if you have not addressed taxes, I'll just say this. If you have not addressed taxes and you don't feel like you have an efficient tax strategy in place, in an environment when we know taxes are only going to go up, schedule a call. Let's have a conversation. Let's get that second opinion, fresh perspective.
Absolutely. And if you do have an advisor and they just totally go around this subject or avoid it or say we can't do anything,
don't worry about it.
What taxes? Everyone's got to pay them. There's nothing you can do.
Death and taxes.
Yeah. Then maybe you should look at finding a new advisor, because I'm a fiduciary advisor, which means I always have to put my client's best interest ahead of mine. And honestly, having that conversation, if it means saving you a significant amount in taxes, you bet I'm going to bring it up, and we're going to look at that and go through the pros and cons. But unfortunately, a lot of the advisors at some of the big banks, their compliance department won't let them even talk about Roth conversions or tax minimization strategies. They just basically, their hands are tied. They're good people, but the system that they're in will not allow them.
Well, you also have to remember, too, a lot of CPAs, their number one job is to save you money in taxes this year. They're not looking at 5 or 6 years down the road. And we've had a lot of conversations with CPAs that, and they've told us straight up, look, our job is to save you in taxes this year. We're not worried about a few years down the road.
Right. They're so caught up that they can't see the forest through the trees is the analogy I use. I love CPAs, but I think a lot of them are very short-sighted. They don't see the impact like we do as retirement planners of the whole big picture down the road, what's going to happen. And some of that has to do with, I wanted to hit this topic before we end today, was leaving a legacy, right? A lot of our clients, they want to spend and have fun in retirement, but they know they're going to have a pretty good nest egg to leave behind for the kids and grandkids. And some of them really want to leave behind a tax-free legacy versus a tax time bomb legacy, as I put it. So, if you leave the kids, let's say you have 2 kids, you leave them what's left of your IRA account. The new legislation says you only have 10 years as a non-spouse beneficiary, your kids only have 10 years to take all that money out of the inherited IRA, and it all counts as ordinary income. And if your kids inherit it, like most kids do, when they're high up in their jobs, successful, already have good salaries, already paying enough in taxes, now they inherit mom or dad's IRA money on top of it and got to drain it in 10 years, it could significantly put them in higher tax brackets. And I always say up to about a third of your legacy money goes right back to the IRS when it could have been much lower if you'd been proactive.
Well, we've yet to sit down with any client and them tell us they don't pay enough in taxes.
Right.
And if you just take that statement right there, you just sit there and you're at your kitchen table, maybe you're on the couch right now, and maybe you're driving in the car. If there was a way to get more efficient with the taxes you pay in retirement, or that whoever's going to inherit the money, if you knew there was a way, then why wouldn't you use it? And there are multiple strategies and ways out there to get more tax efficient. Schedule a call, get that second opinion. And what else you got for me on taxes?
Well, just one last thing on leaving that legacy, leaving the IRA money, it's all taxable, or leave your beneficiary as a Roth IRA. Still have 10 years for most beneficiaries, but guess what? All that income is tax-free. It doesn't matter if you had 500 grand, all 500 taken out in 1 year, great, it's all tax-free.
Maybe they find a lake place. Maybe they want to go on a vacation. Maybe they want to pay off their house. They're able to use that money however they see fit without any issues.
Yep. And there are a few exceptions out there, but again, this is where working with a professional. And we always say we start with what are your goals and dreams in retirement? What's your vision? How do you want to, leave some money behind for the kids? That all should be part of a comprehensive financial plan. From the plan, then we look at what you should be invested in and how you should be invested. And every account, IRA account, should be invested, in our opinion, different than a Roth versus non-qualified money. But again, it all has to be coordinated and working together so you can achieve those goals.
That's why the Freedom First retirement process it's why we do what we do. It all starts with freedom to do what you want, when you want, and use it the way you see fit. And if you don't have those options right now, it's time for a second opinion. There's just no doubt about it.
Yeah, and a lot of people that we meet with and become our clients, they want that freedom. And for a lot of them, it means getting freedom, as much freedom from the government as possible, and getting as tax efficient gets you closer to that goal.
Eventually, RMDs are going to change, right? We hear. I mean, look, they've changed it from 70.5 to 72. A year you didn't have to take RMDs. Then you have to pay it back. And now we're at 73. It's only a matter of time till they switch it up. Maybe you have to take more money out than what you expected. Let's get ahead of that. Let's put a plan in place to address the obvious. It's called being proactive, and that's what we do around here.
Absolutely. Well, I think we've hit taxes pretty well today, and we'll definitely dive into to more taxes in future episodes. But again, if you like what you're hearing, please hit that subscribe button. Share our podcast with friends, relatives, anyone you know that is getting close to that retirement age and could use a second opinion.
Yep. Subscribe, like it, send us some great questions. Excited to get community launched here in the next couple of weeks. And again, my name is Shon Peel.
And I'm Darrin McComas.
And this is Getting Retirement Right.
Thank you.
Thank you for listening to Getting Retirement Right. Make sure you subscribe so you don't miss any future episodes. For more resources, or if you have any specific financial questions, contact us at abrahamco.com. That's abrahamco.com. The Getting Retirement Right podcast and related materials are provided for general information and entertainment purposes only and do not constitute accounting, investing, legal, tax, or professional advice. Visitors should not act upon the content or information found here without first seeking appropriate advice from an accountant, financial advisor, lawyer, or other qualified professional.